Is it just us, or does it seem like owning a trucking company is getting harder and harder? We just learned that trucking companies went out of business 4 times more in 2019 than 2018. So this video is intended to give you some tips on how to avoid the pitfalls to keep your trucking company running smoothly. There are 3 main reasons trucking companies fail: poor expense management, lack of support or an unorganized back office, and poor cash flow management. So let's talk about how you can avoid them. In part 1 of this 2-part video series, you'll learn how to manage expenses and calculate your cost per mile to ensure business success.
I'm Jaime with Apex Capital. Apex has been factoring freight bills for 25 years, and we've helped thousands of trucking company owners achieve financial stability and successfully grow their businesses. One thing we know for sure is that if you want a successful trucking company, you need to manage your expenses and monitor your operating cost. Costs can be fixed, variable, direct, and indirect, and knowing the difference between each type makes managing your operating expenses easier. A monthly truck payment is a good example of a fixed cost because it's the same dollar amount every month, making it easy to predict and budget for. Your fuel costs, on the other hand, are a variable cost. The price of fuel is consistently changing, and you're probably not purchasing the same exact amount each month either. Variable costs are a little harder to estimate. Costs are also either direct or indirect, meaning they're either directly related to generating revenue or they are a byproduct of running your business. For example, fuel and tires are direct costs because you need them to run your truck to produce revenue, while things like food, lodging, or permits are essential to your business, but they won't produce revenue. Next, you have to know your cost per mile. We can't stress this enough because if you don't know your cost per mile, how do you know if you're getting paid enough? To come up with your cost per mile, just add up your total cost for the month, quarter, or year and divide it by the total number of miles driven in that same time period. Once you've got it, then you'll know what rate per mile to accept or negotiate to with your customers. Since costs vary, we suggest you monitor your cost per mile on a regular basis.
If you need help getting started calculating your cost per mile and rate per mile, visit our website or download our cost per mile calculator.
The last part of successfully managing expenses for your trucking company is knowing the difference between your revenue and your profit. Revenue is the amount of money that comes into your business from hauling freight, but your profit or net income is what is left after you've paid all your expenses.
A profit and loss statement can help you analyze your operating costs. Visit our website to download our simple P&L statement. It's our free gift to you.
Those are our tips to help you avoid one of the reasons why trucking companies fail. But remember, there are 2 more reasons we still need to talk about. To get help with support and cash flow management, check out part 2 of this video series.
Thanks for watching. Give us a thumbs up if you like the video. Hit the subscribe button if you haven't already, and hit the bell so you'll get notified when we post our next video. We'll see you on the next one.